Hi, I'm Richard, and this session is going to be on the tax-based definition of a liability for calculating deferred tax in terms of IAS 12. As always, we're going to first have a look at some basic concepts. So, liabilities with a carrying amount today, that carrying amount represents future outflows of economic resources in order to settle that obligation. Now, depending on the tax consequences, that may or may not result in future tax deductions, which in other words is a future benefit. And that future tax deduction must be matched to the future outflow of economic resources, okay? And meaning that today we recognize a deferred tax asset. So, in terms of IAS 12 paragraph 8, we define a tax base of a liability as its carrying amount minus any amount that will be deductible for tax purposes in respect of that liability in future periods. Now that's quite wordy. What we want to do is we want to kind of simplify that into something that can be practically applied, and this is how we're going to do it. The first thing is we need to identify what are the future outflow of resources. The next question is that future outflow tax deductible in the future when it occurs? If the answer is yes, then the tax base of that liability will equal the carrying amount minus any future tax deductions. If the answer is no, the carrying amount will equal the tax base. To illustrate, let's have a look at a provision. For instance, a provision for leave pay. So I'm going to now write out our normal deferred tax balance calc. We're going to have a provision recognized with a carrying amount of 1,000. Now, that provision for leave pay, for instance, is a present obligation, okay, that's going to result in future outflows of economic resources. Are those future outflows going to be tax deductible? That's the question. In this scenario, provision for leave pay, when it's initially raised as an expense, I go debit expense, credit provision for accounting, but the tax authority does not recognize that as a tax deduction. So therefore, the tax base, okay, will be based on the assumption that there will be a future tax deduction when there's a future payment to settle that provision. So the tax base of that liability is going to equal the carrying amount, that is 1,000, minus any future tax deductions. The tax authority will allow the payment as a deduction, but they do not give you the deduction when you recognize the original expense and provision. So the future tax deduction is 1,000 as well. Therefore, the tax base is going to be 0. Bring in my tax base of 0. Now that means I'm going to have a temporary difference in the future of a 1,000 tax deduction, okay, and that means it's going to be a deductible temporary difference, being a deduction in the future taxable income and therefore a reduction of future tax outflows. Therefore, there's going to be a deferred tax that needs to be raised today to match that deduction to the current taxable income, to the current accounting income. So that 1,000 times by, let's say we're using a tax rate of 30%, will result in a future tax saving of 300. A tax saving, well, that's a future benefit, isn't it? So that will be a deferred tax asset recognized today of 300. Now this is going to be in contrast to the scenario when I have an actual creditor. So a creditor means I have received an invoice and I've gone and debited the expense, credit the creditor or accrual. So over here, the carrying amount of this creditor, let's say again 1,000. Well, when I went debit expense, credit creditor, I had an actual accrual on that date, and the taxman says that you get the deduction at the earlier of the accrual or the cash outflow. So here we do have an accrual, so the accounting and tax treatment are going to be identical. They are going to be a tax expense and an accounting expense in the same period. So therefore the tax base over here is going to equal the carrying amount minus, again, future tax deductions. And you'll see over here that the carrying amount of 1,000 minus, there's 0 future tax deductions because I've already received the tax deduction in the period that we're discussing. So the tax base will equal a carrying amount of 1,000. And rightly so, there is no temporary difference, and therefore no future tax consequences, and therefore no deferred tax recognized today. Now please note, although I'm talking about liabilities in total here, the one liability that's going to be separated out with its own definition is the income received in advance, and that will be in our next lecture. The last thing is just the rules for recognizing or classification for the liabilities. Is as follows. Our headings: carrying amount, tax base, temporary difference, and deferred tax. So, for a liability where the carrying amount is bigger than the tax base, that means I'm going to have a future tax deduction, therefore a deductible temporary difference. Deductible temporary difference reduces taxable income in the future, reduces future tax payments. Therefore, it's a future benefit, which is a deferred tax asset. Where the carrying amount is smaller than the tax base, then I will have a taxable temporary difference. And taxable temporary differences mean I have an increase in future taxable income, an increase in future tax payments. Therefore, I have a present obligation, a deferred tax liability. Please make sure you watch the deferred tax lecture now on tax bases for income received in advance. Thank you.